Real estate investment, mortgage points. Get ready because it's time to raise the stakes with real estate. Mortgage points, referencing Investopedia, which is a place you can go to take a look at terms and definitions which are investment related. First thing to note is that the mortgage points come in two major forms, that being origination points and discount points. So that's the first thing you want to understand when you're discussing points. Which category are we talking about, origination points or discount points? Now, in both cases, each point is typically equal to 1% of the total amount mortgaged. So you want to confirm that that is indeed the case, but that's going to be the general rule. So for example, if you had $200,000 home loan, then times 0.01 or 1% would give us the $2,000. So on a $200,000 home loan, 1 point is equal to $2,000. So the origination points, what are the origination points of the two types of points? Remember the two types being origination points and discount points. Looking at now at the first, origination points are used to compensate loan officers. So in that sense, they're kind of more like a fee. So they're kind of using this point system as kind of like a fees type of process. So not all mortgage providers require the payment of origination points, and those that do are often willing to negotiate the fee. So this is one of those areas that you'd want to be doing then comparison shopping for, possibly getting a third-party advice about, and then seeing if it's a negotiating point that you can discuss about. Discount points, on the other hand, discount points are prepaid interest. Notice the difference here, one being in essence a fee that is in this point format, the other being interest. And those implications can have interesting tax implications depending on what the tax law is doing as well, because as we know, the interest is something that may be deductible for many people on the purchase of a home when you're talking about a loan. And then the fees are something that may not be deductible in the same way. And therefore, there's going to be some discussion as to, is this going to be something that is deductible or not deductible? And that's another thing you'd want to be clarifying if it will be significant to your decision-making process. So the purchase of each point typically lowers the interest rate on your mortgage by up to 0.25%. So if you're doing the purchase of the discount points, the question is, well, is it going to be worth our time to be purchasing the discount points, which basically means you're prepaying the interest, right? You're going to be paying the interest up front. And so it's going to, if you look at the time value of money, then the question is, will it be worthwhile to pay the interest up front? And we'll get into that in a bit more detail. Practice problems and sample problems really help us to understand that kind of decision-making process a bit more because it can be quite complex. Now, again, it's 0.25. So the purchase of each point typically lowers the interest rate on your mortgage by up to 0.25. So you want to see exactly what it is in your circumstances. How much will this lower the rate? But if it is 0.25 for each point that was purchased, if your interest rate was 5%, 0.05 minus 0.25, then you would say one more time, 0.05 minus 0.0025. You would expect then the interest rate to be 0.0475 or 4.75%. Now, most lenders provide the opportunity to purchase anywhere from 1 to 3 discount points. So if 1 to 3 discount points, which we said they cost 1% of the loan amount. So once again, if we had the $200,000 loan times 0.01, if we were to purchase points, they would cost us $2,000. If we purchased all 3 points times 3, we're talking $6,000 on the purchase. What would we get in return for paying, in essence, that $6,000 up front? We would be getting, if the reduction in the rate of 0.025, which would be 0.0025 if I move the decimal 2 places over, and then times 3, that would be 0.0075 in this example. And if the interest rate were 5%, so minus 0.05 or 5%, that could take it down to 0.0425, which that could have a significant impact when we think about it going over the whole amortization of the loan, even if it were like a 30-year loan. This can be a little bit confusing to think about whether this will be beneficial or not. Again, quite helpful for us to take a look at example problems here and look at the different circumstances when this could be and may not be a beneficial thing to do to be purchasing the discount points. So discounts, points and taxes. So you want to be aware of the tax law can change from period to period. And clearly the home ownership is one area where the tax law is quite confusing because generally we pay an income tax. So normally from a tax standpoint, you would think that a home purchase is a personal purchase most of the time, and therefore something that's not usually deductible. But of course, they made part of it deductible at one point, mainly the main points being the taxes and the interest, property taxes and interest could be deductible when itemizing, and that in part might have been put in place to try to incentivize home purchase, and most likely was something lobbied for by people that wanted to, increase the home market that are benefiting from it there. So we want to make sure that we have an understanding what the impact would be on the deductibility of interest and the related points impact as well. So prior to the passage of the Tax Cuts and Jobs Act, the TCJA in 2017, covering tax years 2018 to 2025, origination points were not tax deductible, but discount points could be deducted on Schedule A. Now, this kind of made sense because if you look at the points process as we looked at, if you're thinking that the points are only deductible if they're interest related, then the discount points are prepayments of interest. The origination points are basically a point system that is actually charging a fee. And if it was classified as a fee, then you would think it would not be something that would be deductible if you're deducting interest, whereas the one that's a prepaid interest you would think would be deductible. But then they changed that, so this is something you want to keep an eye on just in where your current circumstances are as the tax law changes over time. After the act, discount points are deducted, but limited to the $750,000 of a loan. So then you had that limitation on the loan amount. So you want to take a look at that on the taxes in terms of the interest deductibility, which we might talk about in a bit more detail. In addition, there's a higher standard rate deduction. Therefore, if the standard deduction, there's a higher standard deduction. Therefore, it is advisable to check with a tax accountant to find out if you could receive tax benefits from purchasing points. Now, note, if you're talking to, say, a mortgage broker or anyone that's going to be involved and get paid some kind of commission through your home purchasing process, remember you have this agency problem of talking to them because they have a personal interest. Even though they're working on your behalf, they would like the deal to go through, of course, because they will benefit in some way for it. It would be nice to talk to a tax professional who is a third party who you're paying a salary, which is not involved and does not directly benefit from the purchase of the home, to give you some practical advice in terms of what are going to be the tax implications and possibly do some comparisons that are from a third party perspective. Now, with taxes, it gets quite confusing because if you're talking to someone that wants you to go through, that's going to be benefiting from the process, they're going to emphasize the fact that interest is going to be deductible, and they're going to say, hey, look, you're going to be paying this much in interest, and you're going to get this big tax break from the interest. That may or may not be true as the tax laws change, and you could see the incentives change for the tax law because at some points in times they try to incentivize more home purchasing, and in other points in times they're trying to simplify the tax code and whatnot, and these two things often go in basically opposite directions. When they increased the standard deduction, they made it more people are on the standard deduction. Therefore, there's going to be a bigger gap between going from the standard deduction to itemizing, which could really distort what people might say the benefit would be from getting the deduction related to interest. Because if you're not close to taking the itemized deduction already, then it's not really as big of a benefit. So the only way to really check it out these days is actually to run projections and try to see what is the actual impact of the taxes before and after, looking at the impact of the standard deduction versus the itemized deduction. So again, we might go into that in a bit more detail, but just be aware of the selling points of tax deductions and then the realities of it, and look for third-party advice from a tax professional to get the actual knowledge on that. So note that when lenders advertise rates, they may show a rate that is based on the purchase of points. So when you see advertisements of the rate, then they might try to advertise the best rate they can. The best rate that they would advertise if they were to offer points would be the rate after the points. Now, obviously, to get that lower rate, you would have to pay for the points in order to do that. So when you do your comparison shopping, you got to keep that into consideration. Should you buy discount points? So should you do it? Is it a good idea to buy the discount points if they're available? The answer requires an understanding of the mortgage payment structure. There are two primary factors to consider when thinking about whether or not to pay for discount points. So the general idea would be, okay, they're allowing me to pay for discount points, which is like a prepayment of interest. So that means I have to put the money up front at this point in time. And then they lower the interest rate. And so the question is, well, is that lowered interest rate over the life of the loan, or as long as I'm going to have the loan, as long as I intend to have the loan? In other words, if I intend to sell, shortly or not, is it worth it to do this? And we will work practice problems to kind of demonstrate this, which is way better than talking it out. But just in general, we'll see the factors here. The first is the length of time that you expect to live in the house. So the general rule is the longer you plan to stay, the better your savings if you purchase discount points. So if you're getting a 30-year loan, then oftentimes the points do plan out to work out over the extent of the loan period. So if you're staying there for the 30-year time period, it may be worth getting the points because it could be beneficial if you take that consideration of the long term over the 30 years. However, if you're taking a 30-year loan and you plan on actually only being there for 10 years or something like that, then that's more questionable as to whether or not the upfront payment will pan out given the time value of money and so on, with the lower interest rate that you will be getting in return for the purchase of the points. So should you buy discount points? The second factor to think about involves whether or not you have enough money to pay for them. Now, obviously, many home buyers, if you're purchasing the home, you're putting everything you got on the down payment just to get that covered and whatnot. And then the purchase of the points, you might just simply not have the cash flow in order to do that. And that would basically make the decision, at that point, and right, generally. So many people are barely able to afford the down payment and closing costs and their home purchase, and there just is not enough money left to purchase the points. Now, the next thing to consider could be the time value of money, meaning what if I was to put, $6,000 down or something now, what else could I do that? Couldn't I put that in the market and get a return possibly higher than the benefit that I would be getting from the reduced rate on the mortgage? In other words, you could say, well, you're only reducing the mortgage by so much. I could take that money and I could put it into the stock market and hopefully earn a return that's much higher than the decrease in the rate. And that may well be true. However, there's risk that you're taking on, and what you're kind of doing is trying to secure that the fact that your home is going to be secure as well. So there's a risk reward kind of play off between those two things as well. Time value of money. What else could I do with the money? So some people point out that money paid on discount points could be invested in the stock market, generating a higher returns than the amount saved by paying for the points. However, the average homeowner, the fear of getting into a mortgage they cannot afford may outweigh the potential benefit that could be accrued if they manage to pick up the right investment. So in other words, you're saying I could make more money, like I could make a higher interest rate if I was to invest in the stock market. However, you're really kind of buying insurance for many people. They're worried that if there was a problem in the future, I might not be able to pay the payments. I would like to make it as plausible as possible for me to safeguard that I can make the payments. And if you were to invest in the stock market, there's risk that could go down too in the event of an emergency. And if you were to invest it in something safe, like a savings account, you may not be making a return high enough that would be equivalent to what you would be saving if you were to pay for the points, and so on and so forth. So you could do your comparison, weighing your risks and your rewards here, which once again, we will look at a little bit more detail in practice problems. So in many cases, being able to pay off the mortgage is more important for many people.